Good day everyone, I'm Jimmy, and if you're new to the channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscribe goes a long way in supporting our production. Now, before we dive into today's video, have a look at these disclaimers before we proceed. Today, I'll be continuing on the topic of commodities and strike while the iron is still hot, though we have covered another similar metal like it in depth, which is gold, where you can click the link on the top right if you haven't checked it out yet. We hope that it was informative, and so here we are back again with another area that has been undervalued for quite some time, even before this unprecedented crisis. And by being undervalued, we have dug deep, yes once again, into the news and data before doing our research and determining that it's coffee tea worthy to introduce it to you guys. Alright, without further ado, let's look at one of the world's renowned investors and its interesting addition to his portfolio since the March lows. While sitting on his enormous cash pile, Warren Buffett's Berkshire Hathaway has finally locked onto a new target, Dominion Energy, ticker symbol NYSED. As intimidating as the name of the company might sound, Dominion is an American power and energy company that supplies electricity and natural gas to 13 states. It expects close to 90% of its earnings from its utility companies that provide energy to more than 7 million customers in states like Virginia, North and South Carolina, Ohio, and Utah, just to name some of the few states. Expected to finalize the deal in the last quarter of this year, the conglomerate is spending $4 billion to buy its natural gas transmission and storage assets, which may see the total bill racking up to $10 billion, taking into account the assumption of debt. At its annual shareholder meeting in May this year, there was under everyone's scrutiny, thinking what the next elephant-sized acquisition may be in response to the big sell-off of his airline stocks, which might have cost him above $4 billion, noting, "I've made a mistake." He made a statement saying, "We have not done anything because we don't see anything that attractive to do." Hence, this prompted analysts and investors to speculate further what the Oracle of Omaha will do with Berkshire's $137 billion record cash hoard as financial markets tanked. Well, the wait is finally over as we go on to analyse what's so good about his recent interesting acquisition. First, it increases Berkshire Hathaway's energy's footprint in the natural gas business, as you'll own 18% of all interstate natural gas transmission in the United States, doubling from the 8% currently. Perhaps the great investor himself also sees potential in this cleaner and more sustainable form of energy production in the next decade to come. Next, under this deal, Berkshire Hathaway's Energy will acquire 100% of Dominion Energy Transmission, Quista Pipeline, and Carolina Gas Transmission, and 50% of Iroquois Gas Transmission System. Berkshire will also acquire 25% of Hove Point LNG, export, import, and storage facility for liquefied natural gas, one of just 6 in the US. Basically, we believe that Berkshire's emphasis for this acquisition is more focused on the downstream operations of natural gas, more specifically on transportation through pipelines and storage of natural gas, a less volatile form of investment in an industry with large growth potential amidst this pandemic that may drag on for months or even years for some industries to recover. Lastly, Dominion appears to have shifted its focus throughout the years towards being an environmentally sustainable business that's capable of being profitable in the long run. According to the company's annual reports, it has already achieved 60% of the goal it set out in 2018 to start proceedings by signing contracts for solar and wind energy in Virginia by 2022 to power up to 750,000 homes at peak. In South Carolina, about 2/3 of the agreed solar energy capacity provided by third-party providers have started to be utilized by the customers of Dominion Energy. More recently, it has planned to begin turbine installation more than 25 miles off the coast of Virginia Beach for wind energy that's expected to be functioning later this year. Not only that, Dominion has been actively investing in strategic partnerships valued at $700 million in 7 states to process the methane from animal waste in hog farming and daily operations, and put it into the pipeline systems serving those states. Renewable natural gas in home heating, manufacturing, etc. is carbon beneficial because it captures more emissions from the farms than are released when customers use the gas. To further back this up, the company has stated to be committed to achieving net zero carbon dioxide and methane emissions from its power generation and gas infrastructure operations by 2050. Therefore, we could see a slow transition to a pure-play, regulated utility company that focuses on clean energy production from wind, solar, and natural gas. No wonder he has earned the respect of many investors around the world, scrutinizing every action that he makes, trying to understand and emulate after the man himself, as he seems to be always focused on a bigger picture, ensuring that his investments go into areas in the economy that have a strong growth potential and overlooked by many in order to grow his wealth. While we are on the topic of his ingenuity, we would like to say that Berkshire Hathaway has also recently bought $500 million worth of stocks in Barrick.A, ticker NYSEGOLD, despite publicly stating his distaste for gold due to his inactivity in the market. Some analysts believe that this might not be any investment made by himself, as it's a 0.28% position and probably one of his lieutenants, Ted Weschler or Todd Combs, that capitalized on the wave of surging gold prices, like what we mentioned earlier in our previous videos. After much digress, so what is this natural gas that has been receiving so much popularity these days as prices of oil seem to be ever so volatile, putting the question if there could be a greater focus of an alternative source of cleaner energy in the brilliant minds of economic analysis and executives managing large corporations. And not forgetting the demand of EVs from consumers around the world, causing the influx of billions of dollars worth of investments into cleaner energy in the past decade. Since the Industrial Revolution in the 18th century, coal has been used to power the steam engines that became integral in the evolution of transportation, such as ships and trains, to those that we see today, large cruise ships and Boeings, not forgetting Airbus that run on petrol. Natural gas, the cleanest fossil fuel that is widely used, although the spotlight has been on renewable energy such as wind energy, solar energy, and of course, electric vehicles, that has made headlines and proven many of the industry's brilliant minds wrong when Tesla's stock lifted off, just like the Starship from its brother SpaceX. However, natural gas is still needed to produce electricity for these vehicles, which is a natural occurring hydrocarbon gas mixture and a large component of methane, CH4 for those chemistry students out there. So, to give you a better understanding of natural gas, let's jump into a simplification of the classification of different types of natural gas. Crash course alert, so let's go. It's classified into conventional and unconventional natural gas. For conventional natural gas, it's typically located in between large cracks and spaces between layers of overlaying rocks. It can be produced by a well drilled into such formations, where the gas will flow into the wellbore to be extracted. For unconventional natural gas, referred to as shale or tight gas, is discovered in the tiny spaces within some formations of shale, sandstone, and other types of sedimentary rocks. Hence, the horizontal drilling to release gas from reservoirs using conventional techniques would be rather ineffective. Fortunately, we live in a very high-tech era where hydraulic fracturing to break open rock and release natural gas is employed. This involves pumping fluids containing sand, water, and chemicals into the wellbore at high pressure to make fractures in the rock, in which it will flow into collection wells. Before we move on, we would like to briefly mention that there is another type of natural gas, associated natural gas, that is either dissolved in the deposits of crude oil or above the oil in reservoirs. Have a look at this table for some of such gases. I'm sure chemistry students will find it familiar. After exploring the ways of production of natural gas, the next question is how can it be transported and stored then? Once again, fortunately with technology, there are two forms of natural gas that are currently being transported around the world as we speak: liquefied and compressed natural gas. The former is how natural gas could be transported around in pipelines and ships, subsequently to be stored in underground tanks. Can you imagine transporting the amount of natural gas of 10 ships in its gaseous state to be able to accomplish it with one in its liquid form? That's physics for you. Proceeding to the latter, it's in a supercritical fluid state where distinctive liquid and gas phases do not exist. So, CNG is normally converted from LNG from distribution to end users. Till this point, just a quick recap. We have firstly explored and understood a case study, an industry expert on hidden potentials of natural gas. Secondly, we introduced natural gas and its different classifications so that everyone will get a better understanding of it, and ended it off with its different modes of transportation just to set a basic foundation for the content that we are going to cover in the later videos. Next up, we are going to explore more about a rather abstract concept that's quite relevant to commodities play, especially crude oil and natural gas. Master Limited Partnerships. MLPs are securities that trade like equities and are totally legit as they provide real tax savings from selling units instead of shares because they are partnerships, and hence people who own them are referred to as unit holders or partners instead of shareholders. Some of the pros about investing in MLPs are as follows. Firstly, the distributions are only taxed once, which means that the partners are fully responsible for the taxes, eliminating the corporate level taxation that investors in shares have to bear for their dividends. Next, since MLPs are not charged taxes, they are almost required to pay out all of their cash flows to partners, thus generating a huge yield for partners. Thirdly, they are excellent diversifiers, having a near zero or negative correlation to corporate bonds, government bonds, and gold. Additionally, they have a correlation coefficient of less than 0.5 to both REITs and the S&P 500, thus making it rather less volatile compared to stocks that are benchmarked to the various index. Lastly, MLPs behave almost like a growth stock as there is enormous potential for price appreciation when they are grown purely by building new assets and horizontal acquisitions. To put it simply, according to MSN Money website, MLPs are pure play on the growth in demand for energy without having to worry about the prices of crude oil. However, the shortcomings that MLPs have are, firstly, little voice in companies' decisions. Unlike investing in equities, partners provide investable capital but have little rights on how it's used. Next, tax issues are potentially complex once a unit holder holds a large enough stake in an MLP that will require filing of returns in each state that the business does dealings with. Lastly, risk of potential dilution and very low returns. Since MLPs usually distribute almost all of their cash flows as dividends, there is very little money left over to actually grow the partnership. Thus, they must tap the capital market either by issuing new units or taking on additional debt. When new units are issued, existing unit holders are diluted, the percentage of ownership in the MLP is reduced. On the other hand, when new debt is issued, more cash flows must be used to cover interest payments. Both problems might lead to projections of lower returns, unfortunately destroying the unit holder value. We will consider the last point we made to be the real factor to consider when looking into the fundamentals of such MLPs. Well, in that case, it's especially important to investors who are shaping their portfolio to increase their dividend plays, but not so much for traders, as trading options for commodities would be a much better alternative due to the great amount of time needed for such projects to be completed and growth in terms of volume of natural gas that is subsequently affected by progress and production of such pipelines and storage facilities constructed or acquired. After that rather long introduction, you know how much we love to bring in recommendations of stocks to strengthen our point, but we shall hold you in suspense as in the next video, we'll go on to introduce two stocks that fall into this unique category of MLPs that we can't wait to introduce to you. Till then, be sure to stay tuned to this series of exploring yet another commodity, natural gas. And invest safe.